get back to China, because we're sitting here in Asia and it's the big
happening.
dog. It's happening right now, and a lot of people have been stunned at how quickly this thing has fallen over. Amazingly, nobody was stunned at how quickly it doubled after 5, 6, 7 years of going nowhere when all these other markets were inflating. Just talk a little bit about what you think the causes of this. I mean, you talked about the credit growth, which is extreme by anybody's standards, and yet China's opacity actually is probably its greatest savior in times like this, because no one really knows. And so if you don't know and you can't quantify how extreme that credit expansion's got, you don't really have to deal with it. You can kind of jump on the ship and say, well, yeah, the people are talking these crazy numbers, but we haven't seen the data. So what do you think is actually happening in China right now?
Yeah, again, everything is a process, right? So you had this credit problem, this expansion of credit, the wealth management product, the government financing vehicles, et cetera. And that all started to, as they tried to slow credit expansion, that starts to crumble, that house of cards. So, much like, Mr. Krugman's, let's fix the dot-com bubble by creating a housing bubble. Well, let's fix the shadow banking by providing an alternative source of investment and financing in the stock market. And so let's ramp up the stock market, encourage people to get into the stock market, encourage the use of margin. And then we can take the money that was in wealth management products and put it in the stock market, and then the companies that used to borrow at these high interest rates can now go and issue stock and replace debt that way. And I think the hope we've created so much moral hazard through an implicit guarantee of these wealth management products that are linked to banks, and so we can't really let them go under. If we moved that form of financing to the stock market, then we can get out of the moral hazard business. But sure enough, they juice it up so far that they end up having to provide an implicit, now explicit support. And it reminds me, so again, I had a discussion recently, somebody was explaining that the margin buying was only X% of the total market, so it's no big deal. Sounds a lot like subprime is only X%, so it's no big deal. And then talking about, well, the market's gone up this much, as you say, the market's still up on the year, and so it's not a big deal. It reminds me of a story I asked my former employer when they said, we're not as big in U.S. mortgages as the American banks, so this won't hurt us as bad. And I said, well, how big are you in U.K. mortgages? Oh, we're number one in everything, all right? I said, but that's not a problem because our average loan to value is 60%. So even if it comes down 20%, it won't hurt us. I said, what's your average loan to value in the last 2 years? Right. 95. I said, well, how much capital do you have? So obviously it's going to wipe you out. And so the same sort of story here. Yes, it's still up, but how many people bought it that are underwater? And because they bought it, I don't know exact numbers, but the talk is that you could buy on 20% margins. You're getting 5 times leverage. Well, you're wiped out immediately, right? And so these guys have lost everything. And so now those losses go onto the books of the security companies who are providing the margin. And how much capital do they have, right? Well, not much, right? And so then the losses go onto the banks that lent them the money, or the shadow banking vehicles that lent them the money. And so you're back to this same game, wherever there's leverage, is there enough capital to support it? And when there's not, how do those losses flow through? And, and we'll see. And then, now you've seen all the numbers, right? There's $3 trillion of losses just in this move back, lost wealth. That's a lot of money. You think about what the Fed's $4 trillion did to the world the other way. Yeah. $3 trillion. Now you're talking about a scale of the PBOC's reserves.
Right. But again, people just kind of doesn't really. It'll be okay. They'll figure it out. And I don't know. I'd still stick to this belief that the world is pinning an awful lot of hope on a generation, on first generation capitalists to stick landings that Western democracies have failed to stick permanently. We've never stuck with that. There's always been one of these.
I had that discussion with a renowned guy who I consider maybe the China expert, and he's written a book on China, and his premise was, yes, there's these complications and et cetera, but these are the smartest guys that have ever run China, and they're aware of it, and so they'll manage the soft landing. And I said, well, so they're smarter than Greenspan and Bernanke, and they're smarter than the guys that were running Japan. And I remember when I was in business school, we studied all sorts of textbooks about Japanese models, stuff, because in the 80s, they'd licked it, right? They'd mastered it. They had control. I say, well, China's different. It has control over lending. They tell the banks to lend, they lend. I'm like, well, wait a minute, I'm sure Japan had just as much control.
They did.
And the state-owned enterprises will always invest. Well, let's see, the Keiretsu cross-ownership will always invest. I have a good Japan story now that I started to jump around. But so Japan, sort of the guinea pig for all of this crazy, Japan, who I think by my count is now on QE 18, if you actually count all the different versions they've done. But I was talking with a friend of mine who just recently left the Monetary Policy Board of the Bank of Japan, and is a Harvard-educated PhD, great guy, really, really super guy, and a huge advocate of Abenomics and Kuroda, big supporter, always voted with Kuroda. And he was saying, if it doesn't work, we'll do more. and I said, well, what defines working? And he said, well, working is, what we're targeting with our QQE is a chosen pricing index and the deflationary mindset of the Japanese consumer. and so that's what we have to address with this policy. And I said, okay, that's great. And I believe this policy can sort of address this one directly, because you can pick and choose whatever you want and change import prices every time you want to debase the currency temporarily and get a change in that. This, again, you can maybe have short-term effects, but I said, here's a question for you. What do you guys, when you're sitting in your room there at the Bank of Japan, what do you think causes the deflationary pressure? What is the ultimate cause? Because the deflation didn't arrive like a meteor, even though when they speak about it, the deflation came, and now we have to do this, right? And Janet does the same thing. The recession came, and so now we have to do this. And I said, what do you talk about as the causes of the deflationary pressure? And I was so impressed, barely thought about it, right? I said, so back when this all started, what were the causes? Excess debt, excess employment, excess investment. So that's fantastic. Now, how does QQE address that? And he said, and this is the beauty, right? He said, well, we don't have to. That doesn't exist anymore in the private sector. And I said, yeah, but wouldn't you say that, that's if you've used those terms to define the cause of deflation, I could use those exact three terms to define government in Japan, right? Excess debt, excess employment, excess investment. That is Japanese government, which,
and has been.
Correct me if I'm wrong. Is quite a large part of the economy. And it was, I literally saw like a light go on in his eyes. So, how do you get rid of the deflationary pressure if those causes of it are still so significantly ingrained in how the economy functions?
Well, I presume that's a rhetorical question, because you're right. I mean, one side has to give, but this comes back to this whole idea of yin and yang, and there being this whole thing being a zero-sum game. And you've spoken about how for every winner there has to be a loser, but we're trying to make sure everybody wins all the time.
Well, not everybody. We're trying to make sure the existing haves keep winning.
Right. Okay. Yeah. That's
and generally you're doing it at the expense of the existing have-nots, right? So which again, Janet doesn't define this as inflation, but when the price of retirement securities goes up, that's good for people who already own them with their retirement savings, bad for those who don't yet own them with their retirement savings. When the price of a house goes up, it's good for somebody who owns a house. It's really bad for somebody who doesn't yet own a house, right? And so everything is around, in my head, is you're trying to benefit or protect and sustain the current owners of wealth at the expense of the current and future non-owners of wealth.
But do they even think of it in those terms, do you think? Or because I struggle to get, I go backwards and forwards between the fact that they know exactly what they're doing, and they know exactly what they're targeting, and they're being very, very precise about how they do it within a narrative that they construct that plays to the right people, the voters, the pensioners, and the other side of it, and I don't know which is more terrifying, is they're absolutely clueless, and they're doing what you're talking about, running from fire to fire, just pouring water on whatever they can see, with no strategy whatsoever about what they're doing. I mean, what do you think it is? Because I don't know.
I too go back and forth. Are they completely clueless and don't understand what they're doing? Or, I'll be more cynical than you, are they in on it?
Right. Yeah, which is a third alternative, you're right.
Are they in on it? Do they know, and I said this to you before, that you can narrow down any decision, any policy that the Fed has implemented in memory, forget their dual mandate, you can narrow it down to how does it benefit the banking system? Right? Are you saving banks? Are you creating earnings for banks? Are you extending banking monopolies? Are you, protecting them somehow, some way? And so my cynical side is, this handshake between Wall Street or the corporate elite and Washington, D.C. and the Fed sort of sitting in the top of the triangle deciding how the winners and losers go. I hope not. And like I said, I think I've always thought Professor Yellen was a wonderful person. But man, every day it gets harder to not be cynical.
Right.
Because I also don't think she's dumb. And yet, she goes about and makes public speeches and stuff as though asset price inflation in the buildup of the 07-08 crisis didn't matter. Well, but surely she knows it mattered.
Right, but I think to that point, it's interesting that there are certain things that when you take that job at the Mariner Eccles building, there's some things you have to leave at the door when you go in. Firearms, I would imagine, would be one of them, but a lot of it is your beliefs. You look at, Greenspan's the perfect example of this, and his stance on gold, right? Here's a guy who was dyed-in-the-wool gold bug.
He was a hard money guy.
Right, hard money guy. He's in, no, I don't want to talk about gold. It's a waste of time. It's not important. We don't look at it. We don't manage it. There's a few things he says that make you suggest he thinks otherwise. He's out, and he's on the speaking circuit talking about how gold's the only currency that.
Talking about fiscal prudence, right? And so that off-balance sheet liabilities, and
right.
Where was all that when you were in charge?
Right. And I'm sure you have to toe the line, but this comes around to this idea that central banks in general, and the Fed in particular, are independent, and I just don't see how that flies anymore. How can they be?
Right. And you and I may not completely. I think we both agree they're not independent. I'm probably leaning a little more to they work for the banking system,
right,
versus they work for the government. I might argue the government and the Fed work for the banking system.
I think you're absolutely right.
The guys who create money I don't think it's controversial to say that the private banks, through their fractional reserve construct, are the creators of money, right? The Fed creates reserves, and then these guys multiply it. And the guys who create money control a lot, because you have the prisoner's dilemma, right? If you stop us, we crash everything.
Yeah.
Right? I was at a lunch with our regulator here when, again, around Basel III, early days of Basel III, where they send around, these are some proposals, come back with feedback, and then so I'm kindly got invited because of my relationship, and the rest of it's bankers, right? And the bankers have sat down together and come back with their points, and every single one of their points saying, these things have to be addressed. They can't allow this, was because this will reduce our profitability, and this will reduce our profitability, and this will reduce our profitability. And then final point was, and if it reduces our profitability, then we'll constrain lending, and it'll increase the cost of borrowing, and so it'll hurt your economy.
Yeah.
Well, prisoner's dilemma. Right?
Yeah. Well, the banks have got all these governments over a barrel, realistically. They've allowed it to happen. That doesn't change the fact that you're where you are, and you have to deal with it.
Which, as you say, it's past. It seems to be past virtually, past the ability to deal with it in a reasonable manner. It's right, approaching where the dealing with it is at a minimum on the scale of 08 and maybe more.
Right, but everything's cyclical. I'm a great believer that everything is cyclical. Everything that we're talking about is driven by human beings, and we all have a cycle. there is a cycle to this thing that traditionally you had the business cycle, and you had boom, and you had recession, and you had bust, and it just went around and around. At what point did recession become the thing that we have to fear the most, and the thing that we have to stop at all costs? We cannot have a recession.
Sometime after Volcker, I guess. I guess it was Greenspan. I mean, you saw it. I saw it in '87, and he, slashing rates, and then Japan, '89, '90, slashing rates, and then the Fed slashing rates because of really the impact of Japan, right? So again, in Janet's bathtub model, in Furbis, her DSGE model, it doesn't include the world. It's just the US. So two things that are missing in that model: the world and credit. So, but they cut rates again, and so you get this '93 bubble, all right, and then the '94 hikes, which a lot of people talk about similarity to this liftoff, right? And which led to the Mexican crisis, the tequila crisis, and a real shaky Asia, really shaky, which I think scared Greenspan. So he stopped hiking when his cycle he should have kept hiking. And you can see, I always look at the '95, the trajectory of asset prices, which had gone along like this since '87, all of a sudden switch to that, and then you get this, right? And the concept, again from a simple, Adam Smith capitalism, a recession is inevitably in a good run. People overextend or allocate too many resources to something where the demand's not there, and then the recession is the correction of that, and then you reallocate those resources to something more productive. And we were talking about the BIS annual report, and one of the things they talk about is the impact to productivity and the slowdown in productivity from the bubbles, right? That in the U.S., everybody who used to manufacture something productive became real estate agents and title insurance agents and construction workers, right? And you built way more houses than were needed in the system and sucked up a bunch of labor, and then that opportunity was gone.
But again, these aren't difficult concepts, right? You look at
we
these
learned
things,
these when we were kids.
You learn them when you're a kid, and yet the response to them is so far away from what, if you looked at them objectively, you'd say, well, here's the solution to that. And it feels to me like it's just this massive credit expansion means, okay, well, we've now, as I said, we're in a position where we can't have a bad event because the 2008 was frightening, and people think of it as a near miss. The truth is, with what could happen if they somehow don't manage to contain the next one of these fires you're talking about, it'll make 2008 look like nothing.
Right, and you can almost simplify, again, all central bank policy down to suppression of volatility, right? They're trying to suppress volatility, and yet we know, mathematically, scientifically, the biggest cause of volatility is attempting to suppress it. And this has been my number one argument with the central bankers here in the region for 25, 27 years. They ask me, and some of them I've gotten to know well over the years, they ask me, Dave, so after the European crisis in 2011.
That one, okay. That's which one you're talking about.
Yeah, the European crisis in 2011. So a friend of mine in Indonesia asked me to come and chat with him, who was a senior policy official there. And he said, Dave, why is it, in the European credit crisis, our currency is the most volatile? He said, that's ridiculous because in just the last 18 months, we've grown our reserves $75 billion. We should be the safest. I said, well, you just answered your own question. Right. You've made the market 75 billion short on the other side of you. You've not allowed the natural volatility that would have occurred. And so when one guy wants to buy 1 billion back, the market doesn't own it, you own it. If you don't provide it, then immediately you're the most volatile. You guys have been doing this for 25 years. And they still don't get it. And the Fed doesn't get it, and the ECB doesn't get it, right?
But they can't sit back and do nothing. That's the problem, right?
But why not?
No, I agree with you. Why the hell not?
Yeah, now the PBOC in this, forget what's happening right now, but their ongoing discussions of internationalization of the renminbi, right? This is a conversation that's going on with them. They're saying, well, how do we do this, and how do we make it, a reserve currency? And so their concept is, make it a reserve currency by making it really stable.
Yeah.
And I say that's wrong.
Right.
Right? Allow it to be naturally volatile. Allow the actual risk to be correctly measured by the market participants. And then you don't end up with big imbalances and asymmetric risk positions one way or the other. Well, no, we have to suppress volatility. Volatility is bad. Volatility after it's been suppressed is bad. Natural volatility is good.
Well, to that point, we talk about the renminbi and reserve currencies. What's your view on the dollar right now? Because obviously we're seeing another one of those huge spikes that we get. How do you see that? Because people are split. There are a lot of people that think this is the start of a crushing dollar bull market, and others that think, either way, if you look at that chart, at some point it'll peak, it won't go sideways, it'll go straight down again. But is that here? Is that 20% higher? What's your view on the dollar?
Yeah. Again, in my model where the dollar is the reserve currency that ties all together, it's the biggest provider of credit multiplication during the expansion of liquidity cycle, and it's the biggest impact in the contraction. And so, again, I would argue the pendulum has already started back. We're in that, what historically has been a 2.5 to 3 year contraction period, which then crescendo. So, the last crisis, I start from May 06 and then ended at March 09. And then, everything had burnt, and then they start watering back on, right? And then we start to grow again. So in that contraction in general, because people need to pay back debt, the dollar will strengthen. And so I believe we're in that already. You can, like I said, you can see it in Russia fairly clearly. Right? And you will see it in general that I believe. So I believe we're in a period where the dollar will continue to strengthen, almost regardless of what monetary policy is, because we've already started the credit contraction, right? So China, this massive collapse in asset values and the destruction of margin, the destruction of the expansion of credit is a contraction of credit, and that will prevent additional credit, either because people won't provide it or people won't want it because they've just been killed by it, right? So that's moving my pendulum back this way. That's drying out the grass, right? And so I think in that process, globally in general, the dollar is the biggest participant of that. And so during that contraction, you'll expect the dollar to strengthen. And another one that's kind of interesting, depending on how you think it goes, and of course we have seen it particularly this week, the yen tends to do very well in that, right? So going all the way back to the yen in the late 80s, early 90s, when they started doing their QE and zero interest rate policies, right? Money has poured out of Japan, exactly what QQE is trying to create now. It pours out. But in the contraction, it tends to come back. Yeah. And if that contraction gets sharp, at the end of the cycle, it tends to come back aggressively, right? The repatriation. Japan's still the largest net foreign creditor in the world, right? And so there's a natural tendency in the Japanese in crisis situations for money to come back in. And we saw that very clearly this week. And not giving away any trade secrets per se, but arguably one of the most interesting pricing dynamics, as everybody's been doing QE, everybody ex the US of late, the yen has correlated positively with all other currencies, right? The dollar has gone, we've gone through a dollar move since last summer, and the yen has weakened as everything else has weakened. And so the implied correlation in those cross volatilities is positive. Of course, we know historically, in the event of a crisis, that correlation is extraordinarily negative. The yen behaves as a safe haven because of this repatriation dynamic. So, it's one of the more interesting opportunities in the market, and you see it so clearly this week, where in the heat of things bad this week, the biggest mover is yen crosses, right? Because all of a sudden they go the opposite direction, right?
But that's a peculiarly Asian dynamic. People look at the yen in isolation against the dollar, and that this big short yen, long dollar trade, that everybody's on that train or have been on it and they're off it and they're back on it again. They just look at that one part of the puzzle. But here in Asia, the cross dynamics are
massive.
Potentially, not only massive, but potentially incredibly destructive. Yeah. And they're not so much this week, but they're getting to levels where we could see some really nasty retaliatory pressures from places like Korea. where the government is essentially owned by big business, and I don't mean that in any sense other than there are 6 chaebol that run the country.
Yeah, Korea, again, Korea is, I think, uniquely interesting right now. I mean, they're really backed into the corner, where the drivers of growth, talk about overinvestment. So investment is not what they need more of, right? So their drivers of growth are exports and consumer demand. Yeah. Well, exports aren't growing anywhere because you've got to steal parts of the pie because the pie is shrinking. So that's a problem. And their consumer demand is, stealing a phraseology, is at peak credit usage already, right? So for this latest leg of the cycle, the Bank of Korea saying, well, growth isn't what we want it to be, cut interest rates. Growth isn't what we want it to be, cut interest rates. Growth isn't, cut interest rates. And yet cutting interest rates isn't helping their exports, and cutting interest rates isn't helping their consumer demand because the guy can't borrow anymore no matter how low the interest rate is. And so they cut interest rates. So now you've got the same, sort of another case study of the same problem. They've got a massive asset bubble, no growth, unprecedented consumer debt, and declining global trade.
Right.
So, and at least to date, having lost the battle of the currency war to their main competitors around the world.
Well, they have been smart because they can't. If they'd have started trying to fight that battle to this point, they'd be wiped out. I mean, they can't compete with Japan, and I think they've probably been hoping the Japanese moves wouldn't really work quite as well as it has. So what happens? Because Japan are not only eating Korea's lunch, Japan are in direct competition with Germany as well. I mean, that's going to matter at some point. And so we get to a situation where after 6-7 years of incredible convergence in central bank policy, it feels like it's almost, okay, right, it's every man for himself now. And yet, many of these people have allowed this to go too far, where if you go out on your own, there's really not much you can do. I mean, New Zealand's a good example of that.
Yeah. Well, funnily enough, and again, because I've defined the cycle as this liquidity expansion and contraction, and Japan has played such a significant role in that, in carry trade type dynamics and et cetera, I don't think it's a coincidence. If you look at some long-term charts of yen crosses, several of them have interesting peaks, like in spring of 97 or summer of 08, all right, or potentially as of this week, summer of 15. And I'm not, again, that's just an indicator. It's a proxy of liquidity and leverage expanding and contracting. And Japan is a standalone, unique case study in extraordinary, extreme policy, and they just keep doing the same thing. I mean, Abe's trying to do what he did before. I mean, and again, not to be a fearmonger, but Abe still uses as his sort of roadmap what he refers to the successful policies of 1936.
Correct.
I'm not sure. I think he needs to expand the calendar a little bit to define successful, right? Yeah. But these worked in 36 because they created inflation and debased the currency, and until they didn't work so well. So we'll see. Obviously, Japan. Again, same argument, right? It benefits some people. People say, yeah, but Dave, wages are going up. Yeah. Well, wages are going up in the big exporters, nowhere else. Costs are going up for everybody else.
But there's this idea, the Japanese. I find the Japanese thing interesting because I was there the same time you were, end of the 80s, when it was boom and then bust, and we saw them both almost 31st December '89. It's like flicking a switch. But since then, they've been doing this QQE to the power of 18 in a vacuum. They were doing it on their own, and even though they were the second biggest economy in the world, the rest of the world could kind of carry that, and apart from certain places. Now everybody's doing it, and it's just untenable. It can't continue that way.
Again, in my simple model of the world, the extremeness of behavior is unprecedented, and so the challenges to and you read about it all the time. in a sense, the flaw of this is the reserve currency, is the fiat currency. We went off gold and we went to dollar as the reserve currency, and so now everybody's at the mercy, the exorbitant privilege, and
right.
and now we're taking that to the extreme, right? And so I can't help but think, because I agree with you, everything's a cycle. I'm not saying the world's coming to an end, but
No.
but summer arrives and grass gets dry, and fires become more prevalent, and eventually you have a big fire, and then you start over again. Now the question is how that fire starts, how it spreads, where it's the most painful. In my philosophy, it's the most painful where there's the most grass.
So that brings us back to China. We're talking about the reserve currency and this exorbitant privilege. What's your take on what's going on with China? I don't get the sense that they want the world's reserve currency. I think they want a seat at the table. Can you see the renminbi being opened up in a finite period of time, or is that going to take longer than the market seems to think?
I think it'll take longer than the market thinks. I think it will come with starts and stops, right? Because it'll scare them, right? I mean, I vividly remember the opening of Korea, Taiwan, Indonesia, Thailand, Malaysia. I mean, you remember, Malaysia was the second biggest stock market in Asia once upon a time until they had to close it, right? So everybody likes the idea of capital flows until they don't, and then they tend to react and fall back. So, listen, I think that, no global reserve currency has lasted forever. So nor will the current one. I think, the euro clearly isn't going to replace it, as some may have thought once upon a time. So, the renminbi has a role there. How you get there is going to be complicated. I suspect they're now concerned about having let the CNH market develop, because when they internationalize, they want the currency that's internationalized to be the CNY. And while that seemed like an interesting interim step of allowing an offshore market to develop, again, we've seen some history of how that is, and so somehow they're going to have to figure out how to either merge, which historically hasn't worked very well. So historically, what's happened is they've killed the offshore market, right, and then eventually come back out with their own currency. So we'll see. I jokingly, but honestly, these reserves, these FX reserves that all these guys have, right? Nothing's been a better predictor of crisis than peak FX reserves, right? Because it's just, literally the FX reserve is just a measure of the imbalance. If you want to measure this imbalance, this guy's credit growth looks exactly like this guy's reserve growth. I did a thing for some regulators here once where, back in the crisis, I put up the very familiar picture of U.S. government debt, or, U.S. debt that looks like this. I said, are you guys concerned about that? And they said, well, that's the problem. And then I put on the same slide the picture of Asian FX reserves, which is the same exact line. I said, is that a problem? I said, no. I said, well, I'll argue it's the same problem, right?
Right.
So, I always say, and I criticize my IMF friends who have always propagated this myth that building up FX reserves is good.
Sign of strength.
A sign of strength. And so I always jokingly say, FX reserves are like nuclear weapons. They're only a useful deterrent until you have to use them. And then they're really bad, right? And, here we are again. And in fact, in some of our presentations, I saw, Korean FX reserves, and then, the 97, 07, today, right? So, at some point that's got to fix. At some point this has to better balance out. At some point there has to be a rebalancing. And and we do. We did it in, you did it in 87, 94, 97, 98, SARS even, 07, 08, and 11 and 13, and Russia's reserves were here, and then they went like that. So how we get away from it, it's like the too big to fail problem. Once they're too big to fail, how do you fix it? Right. Well, once you've let the fiat currency and global reserve currency become this toxic disaster zone, how do you go back to gold?
Well, or anything.
How do you fix it?
But you talk about you talk about there being a reset needed. And there have been, as you say, there have been lots, and as you rightly point out, no reserve currency has lasted forever. It's inevitable that there will be a reset. But when you talk about things like a reset, the concept is A, too big for people to get their heads around. They think it's just a crazy, wacky idea that will never happen. And B, because these things haven't happened in the last 40 years, which is most people's referenceable time frame, they just immediately, well, that's ridiculous, it can't happen. And yet it's a very real, not only a possibility, but at this point in the process, a probability, I would think.
Yeah, I mean, the cycle comes, right? And as you mentioned, we're quite deep into this cycle. From a U.S. perspective, we're quite deep into it, and from most of the EM's perspective, we're already, well through the cycle, right? And so you'll have another experience, and the severity of that, how big the fire spreads, how efficiently the fires are managed, how much grass is there is always hard to understand and predict. And inevitably the regulators are fighting the last fire, so they've learned their lesson. Everyone said, but they've learned, right? I said, yeah, exactly. So they've built a firewall, they've parked the fire truck right next to where the fire started last time, and they got their eye right on it. And this time the fire is going to start on the other side of the wall, and there won't be anywhere to drive the truck through, right? That's what always happens, right? I always say, anybody who's hedging the next Lehman crisis may not be hedging the right thing, because I don't think Lehman's going bankrupt again. I said that in a conference in New York once. And so, it's always, it's the same, but it's different. And it's always this, it's just credit, right? It's a buildup of credit and then a contraction of credit and unsustainable credit growth. And, one of my, arguments with Bernanke and, the historians of the Depression, Liaquat Ahmed and these guys, they're adamant that it was the contraction of credit that caused the Depression. And I always say, well, that's like saying it was stopping drinking that caused the hangover.
Right.
It was the unsustainable expansion of credit. That's the disease. The drunk is the disease. The hangover is indicative of the cure. And the cure to the Depression wasn't FDR's New Deal or World War II. It was that credit got wiped out. There was delayed gratification. Nobody consumed through the war. And then after the war, you came out with big government debt that shrunk quickly and created capacity for the growth of private sector debt. And you had fantastic investment and innovation and productivity gains and et cetera. Well, we don't have that right now. The point of my presentation of this thing was the key to risk management is accountability. And that was a real big change I saw in my career. At Bankers Trust, when we were outside the banking due to Glass-Steagall, and we were in the risk business. And my performance objective, running a business, right? I wasn't just a prop, I ran a business, but my performance objective was a capital allocation. When we went to Basel I, capital was the regulator's responsibility. My performance was a revenue number. Maximize revenue, follow these rules. Yeah. I'm no longer responsible for that. And that was sort of the point of my presentation. But a key to risk, everybody, all these risk management policy makers, accountability. It's like, well, that's not what they wanted.
It's a simple concept, and it brings us perfectly full circle back to your Bankers Trust days. Dave, it's been an absolute pleasure. I've really enjoyed talking to you. Thanks for taking the time.
Good fun. Anytime, Grant. Thanks.